The Wall Street Journal is warning of a subprime mortgage crisis, another housing bubble pop, a 2008. In this video, we're going to dive down into the details of this, what truth is there behind the numbers, and what does it mean for you? Are you going to have an opportunity to buy cheaper homes in the near-term future? Let's get into it. First, let's look at the underlying article, and understand what it's about. All right, here we go. First things first. This is an opinion piece. Now, the author is a Stanford educated economist, apparently, that started working for the Wall Street Journal in 2009, and they write opinion columns. Their opinion column, even though it's an opinion column, does provide some data. So let's take a look at this. First, Biden's mortgage relief fuels higher housing prices, and it has created another subprime housing bubble and puts taxpayers at risk. Now, that's interesting. That doesn't sound great. I don't love the idea of hearing about a potential housing crash on top of a stock market crash, on top of recession or tariff fear or whatever is going on, right? So, what do they say? The problems began with the Obama administration, easing underwriting standards by enabling more home buyers whose debt to income exceeded 43% to qualify for government-backed loans. Such borrowers are risky because they might not be able to make payments if their income drops or their expenses rise. Okay, let's translate this to English first of all. FHA loans are indeed typically used by borrowers who have less income. Why? Here's how it works. Let's say you have $10,000 of monthly income between you and your wife or husband or whatever, and you go to qualify for a home. You can have a back-end ratio, which is a fancy way of saying all of your monthly payments, usually greater than 10 months in duration, car payment, housing payment, HOA payments, property taxes, insurance, all of this, all your debts, right? Cars, furniture, loans, whatever you got. They add all of that together. And usually conventional mortgages do not want you to have more than $4,300 in combined payments, housing and everything else. That's 43%, right? So you have $10,000. You got to pay taxes and you got to live, right? Anyway, out of that, they say, hey, no more than 43% should go towards your total debts. Well, FHA, which is government-backed, as to some extent in a quasi-way conventional loans are as well. That's why we have 30-year fixed-rate mortgages in America and you don't in other countries because of government intervention and involvement. FHA allows you generally to go slightly above 50%. So you can actually have total debts in excess of 50% and still qualify for a home loan. And you can qualify with just 3.5% down. Now, I generally see less of a problem with the level of down payment, although that does create less insulation in the event of a market downturn. Because these are 30-year fixed-rate loans, the big question is, can you make the payment? That's what matters, right? So if you have a $500,000 home and it goes down to $400,000 in value, yes, you could be upside down, but are you necessarily going to walk away and start over if you can make the payments? Not necessarily. It could happen, just like it did in 2007, but it depends on how much of a proportion these FHA loans make out of the entire market, right? People are generally payment sensitive. If they lose their jobs or their expenses go up, that's when these become risky. And so, yes, there's absolutely more risk in an FHA loan. So the author is right to say that FHA loans are more risky. Absolutely correct. Now let's get a little bit more insight in the data and see how much of a problem this potentially is. Keep in mind, my entire real estate career has been based on people utilizing FHA loans, including myself in my first home, and taking advantage of these higher debt-to-income ratios. So FHA is a great product, especially for those first timers, but most people have more down payment or higher incomes. They're using conventional loans. Okay, so take a look at this. Such borrowers are risky as expenses rise. This is true. They might not be able to make the payment. Again, it's not necessarily the value of the property, it's the payment. Can they make the payment? Okay, that matters now. About 64% of FHA buyers last year exceeded the 43% threshold. Right. So they show this chart here about how since, the Obama easing basically in the 09 era, 08, 09, you saw more of a use of higher debt to income FHA. Well, of course, because what actually happened was FHA enabled you to come in with a higher debt to income. So the only reason people often went for FHA was because they were over 43% and they didn't qualify for a conventional loan. So this makes sense. If you could qualify under 43%, you're not going to use FHA. Now, FHA does have some other benefits as well. Sometimes the rates can be a little bit lower, sometimes. And they do have lower credit score requirements. Not so great either. Creates more risk, right? So it is a riskier problem. To no surprise, FHA borrowers are missing more payments. About 7.05% of FHA mortgages issued last year went seriously delinquent, 90 days or more past due, within 12 months. And that's more than the 2008 peak of the subprime mortgage bubble of 7.02%. Okay. So now we're comparing FHA loans defaulting now, presently, to 2008. This sounds really bad, any kind of comparison to 2008. Oh my gosh, we're going to have a repeat of 2008. Personally, I think it's more likely we're going to have more of a repeat of 2001 dot-com bubble for the stock market. But let's understand this for a moment. In 2007 and 8, the riskiest subprime loans were not actually FHA loans. FHA loans still actually had underwriting. So in other words, people's jobs were actually verified and their credit was verified for an FHA loan. But what happened was private markets ran away and became so competitive in the lending space that you actually created a housing bubble on the back of what were, I mean, they didn't have this name then, but what would today be called non-qualified mortgages. Basically, private lenders just saying, look, you don't even need a conventional loan. Forget about Fannie Mae or Freddie Mac. Forget about FHA and Ginnie Mae. Don't have to worry about all those names. Just all the government-sponsored entities. Forget about all of them. Why don't you come get our no income, no job, no asset loan, a ninja loan? We'll give you a negative 1% interest rate for the next 12 months, and after that, it'll go to market rates. But you can always refinance because home prices only go up. Those were actually seriously problematic subprime loans. It wasn't the FHA loans that created the 2008 housing crisis. It was those subprime loans. So I think the author here is drawing a parallel that's relatively unfair because FHA loans weren't what caused the financial crisis. Now, I'm not saying that you can't compare these two levels of defaults and say it's a problem. Obviously, defaults rising is a sign of more economic stress, yes. But what percentage of FHA loans or of the mortgage market are FHA loans? All right, so let's get into some data and understand what we're up against here. So first, what we're going to do is we're going to look at the chart of outstanding FHA loans. As you could see in the 2008 financial crisis, it was actually tiny. And this is why when we look at data, you can see the 2008 financial crisis barely made any movement here to FHA loans. Like FHA loan balance outstanding, do you see this tiny dip right there? It went from like $3.7 billion to like $3.3 billion. It's you can't even notice the dip. Substantially higher proportion today. That's its own problem. We'll talk about that. But again, her link is, hey, you know, a lot of people were delinquent in 2008 with FHA mortgages, just like they are today. Okay, that could be a sign of underlying weakness in the economy, but it doesn't necessarily mean that FHA loans were what caused the financial crisis of 2008. Now, $3.6 billion might sound like a lot. In fact, this number right here at the top of the chart might sound like a lot. Remember, I want you to know this about me. If this is your first time here, I'm all about logic, and I'm going to give you all the sides, and I want you to come up with your own conclusions about how relevant this data is in these articles that media folks write. And so I want to give you the information that they're not giving you. And I don't have some motive. It doesn't really matter to me. So I want you to see this. $36 billion. This seems like a lot of outstanding FHA debt, right? Okay. Look at the outstanding debt of the mortgage market. I want you to think about this for a moment. Outstanding loans with FHA, $36 billion. How many dollars do you think are outstanding in the mortgage market? Household and nonprofit organizations, 1 to 4, so not commercial, residential mortgage liability levels. Notice how you actually had a drop in liability levels here? You went from that 10.6 number down to 9.3. So 9.3 divided by 10.6 works out to about a 13% drop in mortgage levels. Notice how you didn't see that drop on FHA? See, FHA loans weren't the problem. Again, they could be a sign of an underlying greater economic problem, but they're not the cause, right? This is causation without correlation. So in other words, I think this Wall Street Journal author points out an interesting economic issue, but it is not what it seems. Now look at where our mortgage market stands today. Do you see that number? 13,284? Yeah, that's in billions of dollars. So this means that the total outstanding 1 to 4 residential mortgage market in the United States sits at $13.2 trillion. Compare that to the FHA market of $36 billion. Okay? So if I take 36 and I divide it by 13,284,000, FHA, in terms of outstanding total debt, and FHA loans are usually smaller anyway because you're first-time homebuyers, total outstanding FHA debt as a proportion of the entire beast is that amount right there, 0.0027. So if I multiply that by 100, it would be that percentage of the entire mortgage market. So this lady is writing you an article about defaults in 0.27%. A quarter of 1% of the entire mortgage market is what she's making an entire subprime housing market bubble video or article on. And notice, like, when somebody makes that sort of allegation, it actually takes time to digest all of this and break this all apart. Okay, Kevin, fine. So a quarter of 1%. Well, what share does FHA have of new originations of loans? Well, I have that information for you as well, because that's my job. I'm not saying real estate prices aren't going to go down. In fact, I've been on this channel warning that real estate prices in areas like Austin, Texas, and parts of Florida are going to go down. I've been screaming it since the end of 2021, beginning of 2022, because of the overbuilding in those markets. And if you look at Austin, Texas today, for the last 3 years, year over year, prices have been coming down, which is the exact opposite of markets like San Diego, California, where everybody's fleeing from California. And I'm like, nah, San Diego is going to be okay. And sure enough, San Diego prices are up year over year for the last 3 years. Look, this is what I do for a living, okay? So I'm a real estate broker. I know real estate. I run a real estate company. We've got a big update coming out for House Hack. We're so ready for whatever happens. If there's a crash in the economy, we're ready to buy the dip. If there's not, we're ready to like keep doing what we're doing. You know, we buy fixer-uppers and provide housing for people. We do great work, and we're going to keep doing that. If you're an accredited investor, you could invest now if you wanted to. You could email us at ir@househack.com. If you're not accredited, stay tuned. Give me another week or two here. We've got something coming for you as well. It's going to be awesome, especially for this market turbulence. But let's understand, and this is not a solicitation video, okay? This is just throwing that out there. You always got to read disclaimers and PPMs and all that kind of offering circular stuff. But look at this, FHA single family market share. Okay, all right. So if we go to 2024, what do we see here? Single family FHA insurance, that's all FHA is. It's an insurance program for defaults, right? Okay, FHA single family mortgage market share by dollar volume. All right, so on purchases, FHA makes up 14% of the new purchase market and 10.2% of the refinance market. And that is in dollar volume. And we'll actually go back to 2008 on this. No, they don't go back to 2008 on any of these charts. So anyway, the FHA mortgage market is extremely tiny relative to the entire market, a quarter of 1%. And of new single-family loans, mind you, this is not duplexes, triplexes, and fourplexes, which were included in the other metric. Of single-family, they only make up about 14% of new purchases. So when we're just looking at FHA, I think we are misleading markets about the housing market. We're misleading people about what kind of leading indicator this is. It wasn't a leading indicator in 2008. It's not a leading indicator now. Am I saying that there's not going to be a housing market, subprime market, crash? It depends on the market. What do I personally think? Well, I personally think that underbuilt areas will probably react just like they did in 2001. Some parts of the real estate market are going to get hit, especially in areas where people are heavily exposed to the stock market if there's a recession. But the qualified loans that we have today, most of that $13 trillion mortgage market is less than a 43% debt to income ratio. Equity levels are very high. There's a lot of buffer. People have locked in low rates. There's a lot of room. In other words, values could go down before people have to panic sell. There's a lot of room between that. People aren't over leveraged because It's really hard to over-leverage real estate after '08. Now that could loosen. There's a lot of talk about killing the Consumer Financial Protection Bureau, which actually created these qualified mortgage and truth in lending rules and tried to prevent the 2008 mortgage bubble. But that's just talk right now. We're just at the early innings of removing that sort of regulation that could create another subprime housing bubble. So are we presently in a subprime housing market bubble? No. Do I think that this is another 2008? No. Do I think we are walking into another 2001 or, something like Great Depression style regarding the stock market? Absolutely. But I just don't see the data yet for real estate. I'm data driven. So anyway, thanks so much for watching. Really appreciate y'all, and we'll see you in the next video. Thanks so much. Goodbye. Good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.